Hi, everyone. My name is David Kosmeter, and I'm the creator of TimingResearch.com. This is Crowd Forecast News, episode 159 for October 30th, 2017. We will be discussing the 214th weekly report, which you should see on your screen right now while I'm talking. If you have not had a chance to take a look at this yet, you can go to TimingResearch.com and download the full PDF there. For those of you watching live, you should see the live chat section of the YouTube page. If you have any questions or comments, excuse me, if you have any questions or comments during the show, you can just type them in there. I have Dean Jenkins back to moderate today, but he's having a little computer issue, but I think he's logged back in now. Dean, are you there?
Yeah, I'm here.
Oh, okay, great. Yeah, I was just doing the introduction, and I'll go ahead and turn it over to you.
Okay, thanks, David. Thanks for having me back. It's good to be here. And yeah, my computer crashed, so I had to reboot real fast, but I'm back. So first thing we'll go through is have each of the panelists just real briefly introduce themselves. And why don't we go ahead and kick that off? Larry, if you'd tell us just real briefly about yourself and your operation there, what you're doing.
Yeah, thanks again for having me here today, David, and thanks, Dean. Yeah, so I've got a site, powercycletrading.com, and it's a trading educational service that I have, and we specialize in directional trading using options for leverage and better controlled risk, and been actively trading for over 30 years. And prior to starting my site, ran a real large international trading desk for a large oil trading company. So a lot of background in trading, all the different commodities and everything. So, but my real passion is, spotting direction, using our directional indicators, and then using options to trade those directional trade setups.
Very good. And that's kind of similar to what I'm doing. I like that as well. Directional trades with options. I'm with you, Larry. Steve, again, if you'd introduce yourself real briefly, tell the people tuned in.
Yeah, thank you very much. I'm Steve Lentz with Discover Options. We are the educational arm of OptionView Systems International. Been in business since 1983. And we primarily focus on the one-on-one mentoring experience, helping folks understand options from A to Z, from beginner all the way up to advanced. Even money managers come to us, and a lot of we get into directional spreads, and then also especially focusing in more on the non-directional trading through butterflies and making adjustments, delta neutral trading, and grinding out profits no matter what the market condition is, but focusing on those conditions that are more conducive to neutral trading as well. So that's kind of our wheelhouse, and it's great to be here.
All right, good to have you here as well. Christian, if you'd take a moment, let us know who you are, what you got going.
Sure, absolutely, and thanks for having me on again as well, David. Really appreciate it. I think I was on for the 150 episode, so that was fun. The balloons came down and everything for the 150 show, so it was fun. My background is I'm the founder of the Tribeca Trade Group, and I specialize in a lot of different trading products, options, ETF, equities, futures, and I have a focus more on trend trading. Previously, my background, I was a director and senior ETF trader with Bank of America Merrill Lynch. While I was there, I pretty much traded everything under the sun in terms of on the equity trading floor. I focused on, I traded for institutional clients, your top 10 hedge funds, provided block trades for those guys in domestic, international, fixed income, commodity, and currency ETFs. I also traded programs, customized indices, futures, swaps, like I said, just about everything. I started the Tribeca Trade Group about 2 years ago, actually about a year and a half ago. It's almost coming up on 2 years. And basically what I did was I just brought my background to retail traders and provide a lot of education day to day into trading, directional trading mostly. So we operate an all-day trading room, starts every day at 8:45 in the morning, And our focus during the day is reading the tape, both option flow as well as cash flow, mostly option flow, and where we're really looking for aggressive and repeat option activity, and basically just looking for ideas. And that's the majority of what I look to do for aggressive option activity, is just look for ideas, and then use our trading system, trend following system, to put on trades and to manage the risk appropriately. So thanks again for having me on.
Hey, great to have you here. And then Anka, if you would introduce yourself. Good to be on with you again.
Hi, everyone. Thank you so much for having me here again today, Dave. And hi, guys. My name is Anka Metcalf, and I have been a trader for about 20 years now. I'm running a firm. It's called TradeOutLoud.com. I'm the founder and CEO, and it is a trading education and service firm that is specialized in educating individuals how to day trade and swing trade stocks, ETFs, and futures, obviously commodities as well as currencies. Prior to becoming a professional independent trader, which I have been doing trading from my own house for the last 14 years. So prior to that period, I come from 10-year plus investment banking experience, and that is back in Europe. I have developed over time a proprietary trading system. I am literally, what I have tried to do is basically adapt it for the retail trader. So taking it from the institutional side and adapting it for the retail trading with a retail trader with a precise set of rules and locations and time locations as well, that all of the institutional traders are looking at. Obviously, I'm a trend trader just like you guys, and it's nice to have only trend traders here. And also, perhaps I'm the only one that is not doing options. So I'm not an options trader. I just trade futures and equities, day trade and swing trade them. Our firm also specializes in coaching, personal coaching. We also host during market hours, and we also trade live. We also provide a trading signal service for futures. And actually next week, we're going to have, for the first time ever, an open house for our live trading room. And it is going to be Monday through Wednesday. It is going to be a 3-day where we're going to let everybody that is interested take a look into our method and what we do on a day-to-day basis. So it's going to be an open house. We're going to open our doors to our strategy, and you're going to hear us trade live and actually provide the market commentary for that. Also I'm a permanent contributor to the Traders Magazine, technical analysis for stocks and commodities. Also, I've been featured on Your Trading Edge, Yahoo.com, et cetera, et cetera. So thanks so much, and I'm looking forward to your questions.
All right, great to have you here, Anka. And I am Dean Jenkins, founder of FollowMeTrades.com. So my service, I offer stock advisory, so a stock picking service. We trade stocks on daily charts, stocks and options. I'm a trend trader, or swing, just trying to catch the next big move, right? So trade stocks and use options for the directional trades. I also have a series of education products, some courses, and a live trading room Monday through Thursday for an hour and a half each morning right at the open. So if anybody's interested, you can check it out, followmetrades.com. There's my website I'm showing right now. All right, so let's go ahead and get into what direction is the market going? That's what it's all about here today. And so David Kosmiter runs Timing Research, and he's got a crowd forecast tool that he's been doing for a long time now. He's published 214 reports, I think he said. And so this week's report, based on the survey and his algorithm, says that there's a 52% chance that the S&P 500 will close lower on Friday than it opened Monday. So what we're going to do is go around the panel and ask each of you what your forecast is. Will the S&P 500 open lower or higher on Friday's close from Monday's open, and what's your confidence on that? And then in the first round, we're just going to ask, up or down, confidence level, and then in the second round we'll get into a chance to, kind of look at a chart if you got it, or for you to, defend the position you're taking, offer your rationale for that. So we're going to start with you, Larry. So what do you think, up or down, and what confidence?
Okay, I'm going to say up. It hasn't been good to say down most of the time, but I'm going to say up, but the confidence level is not too great, so I'll say 55%, and then we'll go into why a little bit later.
Okay, up 55%. Steve, where are we going?
I'm going to say down, and I'm going to give it a 60% on that one, and we'll get into that later too, on the reasons and everything.
Okay, perfect. Christian?
All right, I'm going to go I'm going to go up as well, and I'm going to undercut like Price is Right style, and I'll say 50% for the week, so not a lot of conviction, and I'll get to the reasons in the next part. Thank you.
Okay, 50% up. So you could have said 50% down too, right? Same thing.
I could have, but I chose to be positive. The glass half full, I guess we'll call it.
Okay. Anka, where are we going?
65% to the upside, and I'll explain a little bit later on what I'm watching.
Okay, 65% to the upside. And I'm a very reluctant up, just because that's where the indicators are. I don't really believe it. In my gut, I think we're going down, but I have to follow reality, and reality is it's going up. But I'll give that a 51%. I'm not real confident in it. So let's see. We got 4 up, 1 down. So Larry, we'll go around round 2 here now, and this is a chance where you can show a screen, some indicators, and really build a case for why you think it's going where you said it's going.
Okay. Yeah. So can you see my screen here? Or
yeah, it looks great.
Okay. So yeah. So I think what the thing that concerns me is we've had, it's been an unbelievable market, but we're very, very extended on the NASDAQ. We had just that rip higher last week off the earnings. And, we're getting a little pullback here to kind of work that off. So, typically when you get real extended, the markets do one or two things. They'll either kind of stall and grind sideways, letting the moving averages catch up, or the price will pull back to the moving averages. But in this kind of market, I think it's more likely the markets will just kind of grind and maybe churn sideways. So you can see the NASDAQ here, that big spike, and it's pulled back here a little bit today. So we're getting a pullback here on the S&P, and then the Russell you can see is actually more of a pullback back to that 21 exponential moving average. The Dow's the most consistent, steady of the all of them. So just based on what we've seen over the last few weeks, that big, huge spike higher tend to go with the trend back to the upside. And the other thing too, potentially that could keep the market heated up is we've got Apple's earnings on the 2nd and Facebook, on the 1st. So if you're looking at the various different earnings on the tech stocks, so far everything's been very solid. So I would expect at least Facebook to be good. Apple probably be okay as well. And if those come in line or better, then that will probably keep the market steady to the upside.
All right, very good. Yeah, it'll be interesting to see Apple's forecast. There's rumbling about supply chain problems with iPhone X. So I'm sure everybody will be watching that really close. Steve, what do you think?
Okay.
If you got a chart to show or some indicators, or just talk through your rationale.
There we go. I'm going to try and share my screen and stock program. Can you see my Metastock there?
Yes.
Are you looking? Okay, great. So we have the SPX ascending, of course, and I'm only looking at just this one indicator to give me some great concern, and that's the RSI 14-period RSI, how we have a pretty clear divergence where the S&P made a new high on Friday, yet the RSI 14 clearly failed to, and in fact, the 9 simple and the 45 exponential, those moving averages are converging here, while the other moving averages on the S&P are just channeling up. And if you go back and look at this pattern in the past, this is a real clear, just showing a few tremors before a nice break to the downside, or at least at minimum a wobbling that goes on. But this kind of an RSI divergence is kind of a standard textbook precursor to a correction, or at least at minimum a channeling with very little going on. And in fact, I created a credit spread system in options, and let me roll that out. And if you went to our discoveroptions.com website, you can see up here the option strategy report. And the Russell, I created this RSI divergent credit spread approach that did very, very well, back testing it back to 05. And I've been revisiting that methodology, every year for a long, long time now. But, you can go and take a look at that report, and it further expounds on it. And just kind of happens that in the S&Ps, we have this divergence going on right now. And the trigger on that system was a down close from when the divergence occurred. And so today, if it holds that today's a down close from Friday, then that would be a trigger to maybe sell premium in the calls up there, something like that. But anyway, that's all I'm looking at, and would think that this would finish up Friday lower than on the open today.
All right, thanks, Steve. Christian, if you got a chart or an analysis you want to share, that'd be great.
Yeah, sure. Thank you. And so I think you guys already covered the Qs and S&P, which for the most part, I agree. S&P, I did realize, it got very overbought on the RSI, and that was something that I was cognizant of. And I think, we did get that little bit of a dip at the beginning of last week. And this is basically how it's been all year long. It's, we get a little bit overbought. Maybe we got a little bit more extreme the last couple of weeks on the RSI. I think we got over 80 RSI on the S&P. So we had that little bit of a dip. We kind of came in a little bit, burned off those overbought levels, and then Friday got us right back to almost where we were with about a 67 RSI. So what I'm really concerned with, so first of all, I think, always starting with the S&P is where you want to start with your analysis. But small caps have me a little bit worried today, and that's probably why I'm actually leaning a little bit to, usually I'm about 60-65% every time I come on the show and talk about that. I think we're probably going higher for the week. Although it's difficult to make that judgment just for the next couple days, but overall, I see us going up longer term, but starting to see a little bit of a break in small caps. And small caps can often lead the market move, just like they did a couple weeks, or excuse me, about a month and a half ago. We started to see this big move up at retest or retake of the 200-day moving average. And since that point, it didn't really look back here for about a month. So it really led the market higher. Financials were a big part of that as well. But you could see over here, the last month, we've just been kind of consolidating for IWM. We had a nice day on Friday, but it looks like we're losing it here a little bit. So could be that we've got a little bit of volatility coming. I do think the small caps sometimes lead the overall market move. So I'm concerned about that. But really why I'm not too concerned about making a market prediction for the week, and why I'm right around 50% is because basically it's been a stock pickers market all year long. So as long as we don't have, a huge down day here or there, like the 1% down day or something like that, as long as we continue to kind of grind, we don't even necessarily need to be up, but just the option activity has been unreal in terms of finding which names to kind of go into and play that rolling sector rotation, which is basically what we've got going on a week-to-week basis. I mean, last week it was Tech's week, right? And towards the end of the week, we really saw those FANG names break out, and it was something of a beauty to see all those names basically beat earnings. But it's as soon as things get overbought on a sector basis, which XLK is now, the tech ETF, there's another group that comes right from, to kind of take the lead. A couple of weeks ago, it was industrials and small cap industrials. So, it kind of looks to me like, I don't know, biotech might be up in the rotation. It's been about, biotech has really kind of come in hard, but, kind of showing a little bit of signs of life on Friday. But anyway, that's a long-winded explanation about why I really don't care that much about the overall S&P and what it does this week, because there's just been a number of other opportunities. As long as you're paying attention, you can grab the next sector that is rotating and catching momentum.
Yeah, good comments, and I agree with you that I wouldn't. The question that we're posed here on the panel is, what's the S&P going to do? And I have an opinion on that, but it's not something I'm interested in trading right now. Right? Like, I agree with you. There's other sectors and things to go trade right now.
Yeah, exactly. Yep. Thanks.
Yeah. Christian, you were up at 50%, right?
I just went. That was me.
That's okay. I need to make tick marks here. Anka, you were up pretty strong, 65%. So you got a chart you want to show or something you want to share about that?
All right. Yeah. So the reason why I am up on the SPX, and this is the chart right here. So I'm sharing the chart. Do you guys see the chart? I don't know if everybody can see the charts.
Yeah. Looks
okay.
Great.
Perfect. Okay, so I'm looking at this area of support right here. So far we're holding this area. I'm monitoring very closely, and these are the hourly charts that I'm watching right now, because every single dip from 2013 and now has been bought, right? So it has been a very, and as we're getting closer to these I cannot even say that they're overbought. They're like overbought areas, and they're so extended from any point of view and any indicator that you look at. So definitely we're trading in a very news-driven market, and in a market like today. So today we rallied. Let's take a look at NQ right here. So right off the gates, it just rallied, just made pretty much from very close to pre-market to from about 8 o'clock to about 10:30, it just rallied 50 points straight. And then it decided to pull back a little bit, double bottom right here on the hourly chart. Boom, got bought back again. So very, very strong. Same pattern in the SPX right here. And I agree with Christian about the sector rotation, and that there are a lot of other things that we need to watch other than the SPX. But because we're talking, and the question was about the SPX, I'm looking at this 2570 level as a very strong level of support right here. And as long as this level is going to hold, this is going to be for me the indicator that if we trade below, yeah, we can go a little lower into the 60, 50, 40. I don't think that this week is going to be the week, although we do have FOMC statement on Wednesday, and we do have a lot of earnings that are coming out, including Apple that is coming out. I think it's Thursday after the market closed. Tons of stocks that are reporting earnings, and I think that we're going to go higher based on the technical chart pattern, and also based on the fundamentals that I'm watching and I have on my radar right now. So everything looks very, very strong. As long as these support levels are going to hold here, I mean, I think we're going to continue higher. So everything else, and as you can see here, I'm sharing a chart of the Dow because we do run a signal service as well, and we do have a swing buy alert at 23,200 right here. So we're trying to buy the dip once again if we reach this area. So yeah, we're looking for more potential to the upside. Obviously, we're looking at mini S&P 500 as well. So we're looking at this for higher, obviously on a break of 80. It does have room to continue higher, and we did mention the fact that it has room to continue to 2600. Now, I'm not saying that it's going to do it this week or next week, but this is the trajectory. So this is the next target area that the S&P may be pinpointed at. And I agree with Christian because he touched based on Russell, and Russell has been very, very weak. I mean, it has been weak for the day, and as you can see, there's a strong divergence to the downside. It's down 1.13% in Russell, and I agree because Russell tends to lead the others and the other indexes, and I agree that I focus on these indexes because I trade them on a day-to-day basis because I day trade them as well. But I also look at the longer term. So let's take a look back and let's see what Russell did throughout the year. So throughout the year, Russell literally based from last December until pretty much it was July when it broke out of that very wide range, I would say, and it broke out to the upside, and now it's coming back. It's trying to stabilize again, and it's doing the same dance from swing low to swing high, a very sloppy range. Actually, I do have a watch on Russell, and if the Russell should reverse, my watch for a possible swing long is going to come at 1511, and risk not determined yet as per this trade right now. We need to see the price settle. We need to see the price pivoting before we take a look at the risk. But we see Russell higher only over 1511, and until 1511 is hit, we're going to take a step back. So a lot of these stocks that report a lot of the stocks component of Russell 2000 are just going to start reporting. So that's going to be very interesting to watch. That may be the catalyst that may push the price either higher or lower. Obviously, to the low side in the Russell, if we look on the daily chart here, there's still room for a correction all the way to 1450, and that's going to be our aggressive swing buy if we should get a sell-off in the market. So this is what we're going to be watching. But other than that, to get back to the SPX question, 65% yes to the upside, and possibly run into 80 and 82, perhaps even a little higher into the 85 by the end of the week.
All right, thanks, Anka. Okay, I'm sharing my screen for the S&P 500 futures on a 60-minute chart. So it's the E-mini. And, no surprise, we've been in an uptrend here since when, right? Since August, late August, if you just keep compressing the data, right? Late August, this current move up, not the whole bull trend, but just the current impulsive move up. And it's just unabated, right? It just keeps going. And it's amazing. We had a couple bear traps last week and the week before where it went down, but as I think it was Anka said, the dips got bought. And here we are again, right? We put in new highs, all-time highs last week. So, the definition of an uptrend is higher highs, higher lows, higher highs, higher lows. So we're putting in higher highs. And so that's the reality, right in front of us is the S&P is still in an uptrend. And I use Ichimoku Cloud and a couple other indicators to verify trend and momentum in the direction. And it's down against the cloud and looks like it's reversing. So it's finding support, which is what the Ichimoku Cloud predicts, right? And it's fairly thick at this region, predicting fairly strong support. So it looks like it's going to reverse and probably head up from Monday's open. So that's the reality. I'm only at a 51% confidence just because of the length of this run and the fact that we're due for at least a small pullback in the S&P 500, and we've seen these couple dips, which are bigger than we saw the whole run. And a couple folks have mentioned the Russell, and I wanted to bring that up. So I'm actually short, and I believe, as other folks have said, I think it was Christian and Anka, that the Russell quite often leads the market down. And so I'm actually short the Russell because we have a bearish reality in front of us here in terms of price movement. And after a big run up, it is starting to put in lower lows, lower highs, and now it looks like it's heading into some new lows. I got a target on the Russell. This is a short-term trade. We're going to be in it probably about a week. 144.30. That's just a Fibonacci retracement zone from the trend, the current trend where it started again back in late August. Big move up. Channeled for a while, went sideways, and now we see pretty clear evidence of the down move beginning. So Fibonacci retracement, 38.2 to 61.8, gives us a conservative target down here at 144.30. So we're short. I was trading the Russell with the ETF and plan to be in it about a week. So that's really my thinking. The S&P is heading up, and it has not shown evidence yet of turning around. I expect it, but we don't have evidence of that yet. So got to stick to reality. It's doing what it's doing, not necessarily what I want it to do or what I think it should do. It's doing what it's doing. So that's how we trade. All right. Well, that takes us to the fourth question, and each week David proposes an interesting question. And the question for this week is: have you ever, or do you currently use an auto trading? That's a really interesting question, and I think we'll have some good discussion about that. And so we'll cycle back through the panel. Larry, you're at the top of the batting order. So do you use an auto trading system? Have you ever, or are you considering it? Or what do you think?
Larry, you're muted.
Okay, sorry about that. No, I totally believe in using trading systems or trading models just to make your trading rule-based, because it puts discipline into your trading, and then you don't trade from emotion, you're trading just from your system. So if you have a system that you like, whatever it is, a lot of different technical systems out there, but if you find one that you like, you really should try to stay with the system. But I like discretion. I like to be able to say, okay, I may not want to take this signal, etc. So if you're an individual trader, if you have time to trade, and to me, to be successful, I think you need to kind of do your own, you have to be in charge of your own trades, but, model it with the system and then pull the trigger on your own and use options, etc. So I don't really know a good way to do an automated trading system and also then incorporate options into that. So options are a little bit different animal, but directionally, I like having a system. So that's kind of where I am. And, I've used trading models for 20 years or so. When I was running a large international world trading group, we traded everything, basically foreign exchange and all the commodities. And most of all of our trades were based on trading systems, but then we would actually execute the trades. So, if you're a big, large, huge hedge fund and you've got unlimited resources for technicals and stuff where you can automate it, do automated trading, that's a different animal. But if you're just a small individual trader and you want to do good, I think you have to pull your own, pull the trigger yourself. If you don't have time, then maybe you look at some automated trades. But again, just a summary, I believe in this using a system, but if you're a trader, taking your own trades, pulling the trigger yourself.
All right, very good. Steve, automated trading?
Yeah, we're in the same boat in the sense that we trade options, and we teach options trading from using spreads, and we teach a general set of rules that we can adhere very closely to. However, there are going to be times when you have to make a discretionary judgment, like leaning the Greeks one way or the other, and it's difficult to have a system, so to speak. And so, yeah, I would echo all of that. In the sense of having rules and even back test those rules and forward test them in a small sense to small contract size to get comfortable, and then take it from there. But no, we haven't really done auto trading in that sense.
All right, so 2 for 2 is no. Christian, you break the streak, or do you feel the same way?
Well, kind of yes and no. So for auto trading, I don't use hard stops, but I do use soft stops. So one of the really nice things that's helped the retail trader the last couple of years, it's just been a major catch up between the gap between an institutional trader and a retail trader. A lot of the trading systems now that the retail trader has access to are just much better, much better than they used to be. And coming from kind of both sides, institutional trading as well as retail, I know that from personal experience that just the retail trading systems have just caught up so well. So one of the things that I use in my trading systems and which I rely on is just alerts to tell you where you can place once you get into a trade, which you should always be thinking about. And this is something that we teach in our trading room. You should always be, whenever you get into a position, look at where the position is going to go wrong. So I do set alerts in my trading system to tell me both to get into positions and where the trade's not working, where I at least have to re-examine it. But for a trading portfolio in my cash trading portfolio, which I share with our subscribers, everything is pre-built. So if I get in on the 200-day moving average, I'm going to have it programmed in that my stop will be, basically like an ATR stop below the 200-day moving average. And if it hits that stop, no questions asked, I'm out of it. The 200-day got me in, or the 50-day moving average got me in. It's going to get me out too. The more, and I think it was said, it may have been Larry that said, the more that you could take emotion out of trading into your trading system, the better I think you're going to be. I think in this market, and in any market, more retail traders, when they start, they have a habit of just adding to anything that's down. Their portfolio is down, and we've seen just bad situation after another. Like GE is a great example, right? That thing broke the 200-day moving average. If that wasn't your stop, where and you were adding in a downtrend, it's kind of an opposite of a trend trader, and why I really embrace that strategy, because this is a great example. This thing broke the 200-day moving average, and it's been good night. So regardless of the valuation, regardless of the fundamentals, so having that type of judgment and relying on your trading system, and saying, hey, I'm more confident in my trading system, and being able to embrace those stops more. So we're more confident in our trading system than in any individual pick. And I think once you think about it in that context, it really helps you get around that that personal judgment where, hey, I don't want to take a loser. I have to sell. I have to admit that I'm wrong. If you can get around that, you're so much ahead of the game by having faith in your trading system.
Amen. Amen, brother. I agree with everything you've said. Anka, auto trading?
No, I am not a big fan of auto trading, and that is because I think that still we have to. And let me restart. Okay, so I do like the auto trading system, but that is for big institutions that have. Institutions that are trading large amounts and large a big lot of contracts or shares at a time. But I don't think it is a great opportunity to trade for the retail trader, and there are a lot of reasons behind it. And as Christian mentioned earlier, about using stops, hard stops, and soft stops. This market is not meant for hard stops, because if you take a look at price action and what price action is literally doing, you have to know the precise areas of support resistance, right? And these are areas, they're not exact prices, so they are often tested. For instance, I did a study this year on E-mini NASDAQ, because E-mini NASDAQ has been one of the wildest E-minis yet. So usually as a day trader, you can actually, if you're trading off a 2-minute or a 5-minute chart with more confirmation, you're looking for a risk of about 3 to 5 points. This year was not the case. This year, literally, if you take a look back at setups that have been forming at support, we've had stops of 10 to 12 points, even 15 points to 17 points on very small time frames, maybe 2-minute, maybe 5-minute time frames. And these are very wide for the retail trader. These are specific algorithmic traders, and what they do is they actually take these algos, buy from the stop outs that are literally placing their stops, hard stops at support levels. Even if they're giving that 1 point wiggle room or 2 ticks wiggle room, they're just piercing through that, taking it at a better price, at a discounted price, and pushing it higher. So it was very frustrating. What I think is very important is that each trader needs to be educated. Like, I am not a big fan of having traders join my swing trading programs or joining my day trading program without having prior education. And there are a lot of instances where traders come and they say, oh, I just want to follow you. You follow me, but it's not the same thing. You have to understand what I'm doing, because perhaps maybe I want to take out the stop and I want to give it 1 more or 2 more points because of the things and the elements that I see on the chart. And a regular trader that does not have the trading education may not understand that. And that is the big problem. But in all reality, I think that we need to embrace the algo trading in terms of trade the way they trade, but make it your own. Take your system, your strategy. If you're a beginner trader, just 1 strategy or 2 strategies, pullbacks, let's say, to a moving average of your choice. If you're swing trading to the 50 or the 200. If you're a day trader, look for pullbacks into the 20. Let's say. So have a strategy and run with that strategy. The system, so you need to have a precise trading plan and an action plan of what you need to do on a day-to-day basis. You need to pinpoint your entry for your strategy, and you have to have the patience for these pullbacks. You have to have the patience for the price rotation to pivot at certain points. So you need to have a detailed explanation of where you want to have your entry, where you want to see your stop, and where your stop is, including that little wiggle room that you need to make sure that you compute into your risk. Also, target areas. So you need to have all this information before you push the button. And I'm a big advocate about trading, trading manually, not even using trailing stops, automatic trailing stops, but trailing your own based on what you see on the chart. And the system needs to tell you what you need to trade. For instance, in a day like today, we saw the big divergence even before the market opened. So we started the morning with E-mini Nasdaq being just 1 point down, while Russell and E-mini Dow were the weakest for the day. And we saw what happened. Now, at this point, we're still into divergence. We're still into divergent territory, but it's very hard to trade a divergent market. So you have to make sure that you look at specific areas and you identify what to trade. So your system also needs to tell you what are you going to trade on that specific day. We're talking today about the SPX, and I'm definitely trading the S&P 500, and I'm looking at it every day. And I think that the most important thing is to watch for key levels and the behavior that is happening at these key levels. Also, decide the risk. I think that you should have a solid money management plan in place, a trailing technique, so mimic whatever the algos are doing, but having it on your own. And also, I think psychology and the way we react to shakeouts in order to, and how we react to losses is very important, because we're trying to take emotions out of our trading, but in reality, you cannot eliminate emotions 100%. You cannot do that. Emotions are the most precious commodity. Why? Because you're dealing with money, and money is the most precious commodity, and you cannot eliminate emotions. That's the reason why a lot of traders succeed when they're trading a simulated account, and tons of traders, when they switch to the real account, they lose their money. Why? Because of this psychology, because of these emotions. So you have to make sure that you have a system in place that you respect on a day-to-day basis. You select certain hours for your trading and go from there. So you have to mimic whatever the algos, whatever the big machines are doing, the HFTs are doing, but do your own system, just like them.
Okay, thank you, Anka. A lot of good points, and pretty much everything that's been covered. I don't know that I have anything new to add. So I do not, if the definition of auto trading is that it places the orders, then I definitely do not do that. Right? I think everybody has reiterated or stated the importance of having a trading system, a set of rules that are black and white, and I would echo that 100%. I agree with that, and I do. Right? I have black and white trading rules, and I do not take a trade unless it meets all the criteria. But I want to look at the chart. Right? I'm scanning daily through, dozens to hundreds of stock charts, and I'll see, a good handful that meet my criteria. But I keep looking until I find, just higher probability, the best setup, and I want to have that judgment. I think there's science and there's a bit of art to it and experience, right? So I want to pick the best out of the best based on my experience, and then apply my black and white trading rules. Are the criteria met? And then, and I think people have made this point, I'll just repeat it, and that is, before I get into a trade, I've got, obviously an entry point, a target, and a stop. And I get asked a lot, is it critical, is it essential to have a hard stop, meaning, a stop market, stop limit order in place? And, that's an individual question. I guess the answer would be, do you have the discipline to execute the trade if it hits that stop? I use alerts. I think Christian was said when he said he uses alerts. So I use alerts, right? If it hits my predetermined stop level, then I go place the order, right? But I've learned over years, and developed the discipline to do that, right? I never second guess it and, you know, oh, well, let's just wait and see if it gets better, it comes back, because that is a recipe for disaster. I like the GE example, right? If you wait, pretty soon it's going to be so big of a loss potentially that despair sets in, and you, oh, I can't close that now. I can't take that loss. I'll just sit here and wait it out, and you go down this really negative spiral. So whether you have a hard stop or a soft stop, you know, I actually, you can see on my chart that I'm sharing, I actually draw a red line, right? I put a red horizontal line. That is my stop. So that's my current stop on IWM. It's 149.99. And I got an alert said if we hit it, I'm going to go close that trade. No questions asked. And I think that's important. And I liked Anka's comments and dialogue on stop placement and management. I'm always amazed when I hear people say, you know, well, for my stop, I just place it at 5% or, you know, at some arbitrary dollar or percent level. And it's like, you know, 5% movement for some stocks is normal variation, right? You would expect it. So you're just going to get stopped down on normal price movement. And I think Anka was saying, and I just totally agree, place your stops based on the reality of the chart, right? At key support and resistance areas, right? And on IWM, this is the last high. And if price goes above that high, that means this downtrend that looks like it's starting has failed and it's heading up. That's where I want to get out based on the reality of price movement, not some arbitrary percent or dollar amount, right? And then I size my entry based on the distance from the entry to the stop, right? Figure out, I use the 2% rule. I'm not going to lose more than 2% of my account on any given trade. So I figure out what the entry to the stop is, then determine what the position size is based on that distance, right? And then manage the trade. And as it moves down and puts in lower lows, lower highs, I'll start trading my stop to the previous lower highs till the trend is over and it closes. That's how I do it. But I have no interest in having a machine place my orders for me. And I'm trading primarily on 60-minute or daily charts, so there's plenty of time. I don't think it would really buy me anything. I think auto trading is, you know, primarily used on, you know, really short time frames, scalping kind of things where you don't even have time to analyze it, right? You need the machine figuring out whether your criteria is hit and executing the trades. You know, auto trade is kind of like autonomous driving, right? You know, if I were to ride in an autonomous car, that'd be interesting, it'd be cool, but I'm going to have my hands close to the wheel and my foot close to the brake, right? I'm not interested in letting a machine be in charge of my money just yet. So that's my thoughts. And again, reiterating several points. A lot of good points were made. A lot of just good tips for a disciplined professional approach to trading. So good stuff. Well, the next round here is where we get to share a trade idea. So whatever you're looking at that you like right now as a good trade that you're getting ready to take or you just got into, this would be the time where you go ahead and share that with the folks watching. So Larry, what do you like, man?
Well, one trade that I think is one trade that looks that we've been had on for a while, took it off last week and looking at, I think it looks good to put it back on, is being short. You know, we talk about the Russell here. So here's the RUT, the CBOE Russell Index. It's a good one for doing credit spreads. So you can see this is starting to kind of fizzle out here today. So kind of a reversal back down. And it's had, you know, negative momentum the whole time that it was going up. So that's kind of divergent. So one trade setup that we've been doing is to sell out of the money bear call credit spreads on the Russell. So that way you can, you know, it's making money even if it's going sideways because you're playing time decay theta. So if you look at this chart here, this is the Russell RUT on a weekly. So if you look at the Fibonacci levels, it's here to the 1618, and it just cannot pierce through. And you can see the highs are getting a little bit lower. So it's a perfect kind of setup to then go out and sell. What I try to do is like a 1 standard deviation type setup out of the market. So basically selling a 20 delta and going out to 15, 20 days out to, you know, since implied volatility is so low, it's hard to get a good fat premium. So if you go out here to about the 20, 24 days out, sell the 15, 30, 35 bear call credit spread, get about $1. and then just let theta decay. If it just goes sideways, just, you know, eat up the premium and put it in your pocket. So that's been working really well. We've been doing those in and out for, you know, a couple of weeks since it's been trading sideways like this, and I think it's a good one to do again.
All right. Thank you, Larry. Steve, what do you like right now?
Well, just in coinciding with, let's click on screen share. There we go. Let's click this. There we go. Let's see. We were looking at the divergence, as I mentioned, with the RSI and the S&Ps, and in a similar type trade as you just heard, selling out of the money call premium in light of the divergence and the weakening uptrend, kind of the plateauing. You know, statistically, we know when this pattern happens, at least historically, it's much less likely that the market is going to continue upward at a full 1 standard deviation plus pace. It may go up, but it's going to go up a lot slower, at least historically, based upon these patterns with the indicator, the RSI, than what it normally does on an uptrend without that divergence. And so the idea, as you just heard, I think it was Larry mentioned, you sell premium, a standard deviation out of the money in the calls, and at least in option view, you can easily, you know, we color the strikes different, you know, different colors depending on what standard deviation they lie in. So here's the weekly expiring December 1st. You could go out there to a standard deviation, and if you come out to December, well, then you'd have to come out a little bit further to sell premium out there. So you can get more premium certainly coming out to December, you know, with that spread than coming out in for the weekly. But in either case, you go out a standard deviation, maybe to the 26.25 call and sell premium there, or going out to the DC expiration, go out to the maybe the 26.35 or the 40. The 40 has more open interest, so maybe go to something like that. And you do a bear call spread and collect the premium just like that. And you don't have, and the nice thing with bear call spreads, you don't have to be so precise. You just have to be generally correct, and that the market doesn't move up that full standard deviation. It can drift up as long as it wobbles around for a period of time. You know, you're still going to make your money. And so that's why we like option spreads and combining it with technical analysis like this.
All right. Thank you, Steve. Christian, what do you got up your sleeve? What do you like right now?
Yeah, I was just going to give this trade idea. If I was up first in the rotation, I would say go long Dunkin' Brands here, right around $56. But no, I'm just kidding. I guess there's some news out on I always like to do that every time. So this is the favorite part of the call for me. I love to go over trade ideas, and one of my favorite trades this year, since we've been in an uptrend all over the place, is to buy areas of the market that get a little bit of weak. Like I think a couple of you have mentioned rotation. So we've seen this just over and over, where things kind of get to the highs, they come back down a little bit. So what I'm looking at is, you know, one group that is outperformed hugely this year, which is the China internet names. So these are your Baba, your JD, your Baidu, your NTES. So this group as a whole, there is an ETF for this group. It's KWEB, KWEB, and you could see it's had a great year, up 60%. And it's not just one name that's in it. It's basically been the whole group that's outperforming. And you could see the constituents of the basket. Now, the one thing that you have to watch out for is a lot of them are reporting earnings this week, like Alibaba reports this week, and JD reports, I think not this week, but next week. And then it's kind of staggered. But a lot of these names have had great momentum. So what's nice about this, the ETF, is you don't have to have the exposure to any one of these names because they're pretty volatile. They're pretty volatile names. And one of the things that we look at is the relationship between what this China Internet Group has been doing versus the Hang Seng, which trades overnight, right? By the time we come in for the day, traders in the US, the Asian markets are closed, so the Hang Seng is closed. But so you can kind of get a nice lead on what is going on with this group based on what the Hang Seng does. And you can see the relationship. The candlestick chart is the K-Web ETF, and the orange line is the Hang Seng index, right? And you can kind of see it's got a pretty nice fit. A lot of times it touches, not all the time. You could see that the Hang Seng actually got a little bit ahead of the Chinese Internet Group a little bit of the year, around February, and you can kind of see the same thing is happening right now. So this Chinese Internet Group has been selling off. Maybe it was a little bit of Baidu last week. I think JD's been a little bit has been weak. Baba actually took a little bit of a breather last week and then came to life at the end of the week. But you can kind of see the divergence that's been taking place right now. So either one of two things is going to happen here. Either the Hang Seng starts to sell off and kind of meets down with the Chinese Internet names, which are mostly ADRs, or the K-Web ETF is going to rally and come up and meet the Hang Seng, which again, it seems to do that quite frequently in the last year. Notice as well, I have the green line here. That's the 100-day moving average. So you've got your defined support, something that we were talking about before with trend trading and auto trading and having soft stops. So you've got your defined support here. So I like going long here, the K-Web, the Chinese Internet names, a group that has been outperforming all year long and is on a dip into the 100-day moving average. So that's how I would play it. Where I would abandon this trade, which I think is always important, is if it breaks the 100-day moving average, because I don't have the 200-day moving average drawn here, but it's a decent clip down. And then it's also a nice, easy way to get exposure to some of those names. If you think Baba is going to have a great earnings report and pop, then this is the right trade for you, because it'll be a cheaper way even to play in options than it is to play through Baba outright. And then I have one other trade idea. As I mentioned, we look at option activity all day long. And one of the things that's been seeing repeat activity is the second tier gaming stocks. So your Penn National Gaming, your Boyd, there's another name which I can't think of it, but nice repeat call buying we've been seeing in this name as it's been breaking out. It reported earnings last week. So we're seeing some post-earnings aggressive call buying going up. So that's a couple trade ideas to look at.
All right. Really, really interesting. Thank you, Christian. Anka, what do you got going? What do you like right now?
So I'm looking for a pullback in a mini Dow, like I've mentioned a little earlier. I'm going to pull the 1 hour chart right here. So if we should get a pullback, I'm looking to buy into the 23,200 area back again around this area. So I'm going to have probably a 20-point cushion around this area. So I'm going to, I already set some alerts into the 30s, into the 20s, into the 15, and all the way into the whole number right here. So I'm going to be looking for a pullback into this area for a possible continuation higher, rotation back to the upside from this pivoting area at the 200. And this is what I'm looking in a mini Dow. And I'm also looking at some other possibilities here. And I do have an ETF, and this is the XBI, as long as, and this is the 1 hour chart. Price got rejected right here into resistance at $85 area. I'm looking for this cross here at $83 to hold. If this is going to pull back into the $83 area, it might have another shot of continuing higher, and probably with a tighter stop based on the hourly chart. And this would be a trade that will probably, I'm looking at now, possibly into FOMC. So I like to be kind of flat-ish into FOMC, just some other long-term trades that I'm willing to hold. But other than that, this is what I'm watching in the market right now. And obviously there are a lot of opportunities, and traders that know me and follow me, I do post tons of trade ideas for free on Twitter. It is twitter.com/tradeoutloud.
All right. Thank you, Anka. All right. I'm showing a chart here. The kind of my favorite trade right now is a stock. It's an energy related stock on a daily chart, and it is symbol CLR, Continental Resources. And so I like Elliott Wave. That's the very simple version of Elliott Wave is the core of my analysis. And so we got a really strong impulsive move. This is a wave 3. It retraced into a correction zone, a Fibonacci correction zone between these two blue lines, went a little deep, but stayed above the disqualifying level of 76.4, and then showed clear evidence of the next impulsive move beginning. As we got a price target zone established based on Fibonacci extensions from the other two moves up here above $58. 56.22 is my target, actually, 56.22. But this is the whole target zone up to about 71. And we got long this thing at 36.80. It's this light blue line. My current stop is right here under the previous low. And there's a long way to go on this trade, and it's really going our way. And you can see it just broke the 200 SMA, so that's a really good sign. And we got in, it pulled back a little bit, found some support at the Ichimoku cloud now. You know, higher high, higher low, higher high, moving up in an uptrend, and it looks really strong, and there's plenty of room and time. The reward to risk on this, even at this, is about 4 or 5 to 1. So that's a great reward to risk ratio. And for a trade like this, for me, the highest return, lowest risk approach is just to buy a directional options. We just buy calls on this thing. We are trading this one with on the CLR. What's the contract here? It is the January 31 calls. So I like, on a directional trade, deep in the money, high delta, plenty of time for the trade to play out. So we're in them 6 to 8 weeks, and we want at least 30 days on the back end so we don't have any kind of theta problems. We want to be out of it before we get into that last 30 days. And we just want the maximum premium gain to sell this thing later. And we get that with a high delta entry. So that's what CLR, Continental Resources, is my trade for today. And I like it a lot. And looking really, really good. Well, hey, we're already, wow, we're an hour in, and it's been a great discussion. Maybe if each person would take 30 seconds or less, just a quick wrap-up thought, a website or a link or something you'd like to share, and then we'll go ahead and shut it down. So one more time through the order here, Larry. Any last minute thoughts? You might be muted if you're talking. Let's go to Steve real quick. Steve.
Okay, thank you. Yeah, thanks a lot for having me. I just want to point out that we have an option view. We do offer a free trial of the software. And then just back to mention the options trading strategy report that tees off on the technicals that we discussed earlier today with regards to the index market and the RSI. But thanks again for having me. I really appreciate it.
Great to have you here, Steve. Christian, closing thoughts?
Yeah, sure. Yeah, really like that trade idea too. CLR just recaptured the 200-day moving average, so I might go into that as well. Nice trade idea, I like it.
All right, thanks.
So yeah, we have on Tribeca Trade Group just our packages. It's our Elite Trader package. You get half off the first month, TTG, and you can see all the product services that you could get with that. But what I really wanted to plug is we're having a webinar today at 4:30 today, so a half hour after the close today, and just on option basics. You know, I think a lot of times things get lost. You know, so you hear on Twitter all the time sweep or risk reversal. We're going to be going over all these, what they mean. So if you've heard these terms, you don't know exactly what they are, I'm going to be going over them, and from an institutional type trading background to kind of explain each one of these and how I used to actually make these orders on the tape. So hope to see you there. My handle on Twitter is @CFromhertz, my first initial and last name. Thanks again for having me. Always enjoy being on the panel. Thanks, everybody.
All right, great. Thanks for being here, Christian. Larry, did you get your mic open?
Oh, yeah. Sorry about that. Yeah. So
whoop.
Hey, you're muted again, Larry.
Can you hear me now?
Yes.
Yeah. Okay. Sorry about that with the old mute. Yeah. If you have a chance, go to powercycletrading.com right here and check out all the free information. We have educational tools and stuff and ebooks. So powercycletrading.com, and thanks again for having me here today, Dean and David, and have a great rest of your week.
All right. Good to have you here, Larry. And Anka, closing comments or thoughts?
I suggest we trade very, very carefully this week because we have a plethora of events and we have a lot of earnings. So we need to monitor the market one day at a time, and don't forget to use your stops. Don't forget to stop out because that is a pre-planned risk that you're applying, and then look to follow your plan. We also have a trading room trial. It is next week, so the date is wrong here, but it is actually from November. So it's next Monday, November 6th through November 8th. It is 3 days open. We're going to let everybody in to take a look into our trading method, how we trade, how we set our entry stops, targets, etc., what our game plan is, our action plan, and etc. So feel free to follow us on Twitter /TradeOutLoud, and we post a lot of trading ideas for free there, also on Facebook, and that's where you're going to be receiving the link. And also make sure you visit our website and you get on our email list, because that's very important to find out about all these events. We also have a free webinar about trading futures and how to get started with trading futures and important elements that you need to consider, and that's this Friday at Thursday at starting at 7 p.m. So thanks so much for having me today. Looking forward to next show, and everybody have a great rest of the day.
All right, thanks, Anka. And again, I'm Dean Jenkins, followmetrades.com. This is my website here, and we've got again a stock advisory service training. There's my ongoing record over the years posted there, complete transparency. You can click in a year and see every single trade we took, and the results are audited by an external CPA firm. And if you're interested in just kind of tuning in and finding out more, a nice, easy way is to sign up for our weekly newsletter. It's called Beyond the Noise, and that's free. All right, great to be here. Great discussion. I really enjoyed all the panelists and your comments, and I think it was really valuable. So I enjoyed it, and I look forward to the next time I'll be here. And I'm going to go ahead and wrap it up and turn it back over to you, David.
All right, thanks everyone. Great show. Just want to remind everyone watching, be sure to hit the YouTube subscribe button if you haven't yet, to get updates on future shows. There will be no episode of Analyze Your Trade tomorrow night, as usual, but both shows will be back next week. Monday, November 6th at 1 p.m. Eastern Time for the next episode of this show, Crowd Forecast News. And then Tuesday, November 7th, 9 p.m. Eastern Time will be the next episode of Analyze Your Trade. And Dean will be back to moderate that as well. And Anka will be back for that one as well, I think. So I just want to thank my guests again for this week. Larry Gaines of PowerCycleTrading.com. Steve Lentz of OptionView.com. Christian Fromhertz of TribecaTradeGroup.com. Anka Metcalf of TradeOutLoud.com, and Dean Jenkins of FollowMeTrades.com. Thanks, everyone.